Boaz, your flagship fund was among the big winners in the pandemic sell-off. You bet on volatility, and those positions paid off massively. What are you betting on now?
I think that we're due for renewed volatility. And I don't say that because I have any kind of crystal ball, or certainly mine is often or cloudy or mostly cloudy. I say that because the credit market has recovered almost back to where we were pre-pandemic. So as measured by credit spreads, and you might have to do a little fancy work, which we'll get into, to really unpack what do we mean when we say credit spreads. But when I look at how low credit spreads are today versus objective measures of future volatility, like the VIX, and even in our own minds, when we think about the onslaught of news that's going to come out, I believe that credit, when spreads are low as they are today, is asymmetric. It's short vol, and I want to delve into that deeply. And I think the markets are rightly telling us that there's a very good chance for volatility. It might mean the market goes up or down, but as a credit investor with meager spreads, you only are exposed to the wrong side of that.
The past few months, Boaz, have been relatively calm. Why are you confident more turmoil lies ahead? Because the VIX, to your point, is elevated, but it's been elevated.
Yeah. Now, first of all, I think it's like a calm before the storm. There's a reason there's calm. It's because there's a date known certain, November 3rd, where there might be an incredible move, there might not. And with respect to equities, that doesn't necessarily mean something good or bad. As an equity investor, you have the benefit of asymmetry. Stocks can go up more than 100%. Just look at Tesla. Stocks can only go down 100%. But in credit, you're exposed to that asymmetry. And so I think the market is waiting for further direction, not just on the election, of course on COVID, of course on whether the recovery that we have had is going to be short-lived or it will support itself. And so the market is in a very tenuous place right now. And so you're right, we haven't really moved that much because everyone's waiting to see how the fourth quarter shapes up with the incredible, almost unprecedented amount of historic news to come.
What do you think the chances are of an incredible move on November the 3rd?
Well, so it doesn't, of course, have to come on the third versus the fourth. I again I have views, but what I'm doing right now is trying to think hard about if there's a negative outcome in the market, and it won't be because the Fed backs off. The Fed has really been holding the market up, but if the second wave of infections is even worse than people think, if we have a contested election, on, or even in ways where that are unknown unknowns, I think that the chance for a very significant move is there, and it's not evidenced by my crystal ball. It's evidenced by what it means for the options market to have elevated volatility. It's not telling you about direction, it's telling you about the range of outcomes. And one of the most important things that I think I can do when I talk about the credit markets with investors is try to frame credit spreads in an options lens. And when credit spreads are very low, they only can go a little bit lower, and you're exposed. Your margin of safety is so small. And so there's an element in credit spreads of asymmetry. There's an element in credit spreads of being short volatility. And when volatility is elevated in other germane markets like US equities, that's a sign that in that range of outcomes, if you were a Tesla stockholder and you tell me I tell you there's going to be a lot of volatility, it can go up 300%, it can go down 80%, whatever that may be. It doesn't mean anything bad. But no matter how great Tesla does as a bondholder, you will never earn more than your coupons, and you hope to get your principal back. And that truism is why at least when I think about our approach to credit, it's to take volatility very seriously, because it's one of the major risks that I think is overlooked when people think about what is baked into their credit spread. You're getting a spread of 3% or 4%. What is that compensation for? Most people think it's for defaults and that's it. And I have a pretty long list of other sorts of risks that you're exposed to. Of course, one of the main ones is mark-to-market asymmetry, which is what we've been talking about.